Welcome to the Deep Dive, the show where we cut through the noise to bring you the essential insights from the most comprehensive research. Today, we're plunging into the fascinating world of SoFi Technologies. Now, here's a company that started as a student loan disruptor, right? But it's evolved into, well, a full-fledged financial powerhouse. They've hit impressive growth milestones and, get this, 7 consecutive quarters of GAAP profitability. That's huge. But here's the burning question, really, for you, the long-term value investor. Has the market gotten a bit ahead of itself? Is SoFi, priced for near-perfect execution? Or is this actually a durable long-term winner ready to deliver?
That's the core tension, isn't it?
Exactly. So our mission today is to give you a comprehensive, balanced, and hopefully digestible analysis of SoFi Technologies, Inc. That's NASDAQ ticker SoFi. We're pulling insights from a detailed research report dated August 27, 2025. Back then, its share price was $26.15. We'll scrutinize every facet of their business, really try to understand if SoFi is truly on the path to becoming a durable, top-tier financial institution. Okay, part 1. The foundation, business, management, and financials. To kick things off, let's dive into Chapter 1, business analysis. We need to truly grasp what makes SoFi tick. SoFi positions itself as, a one-stop shop for digital financial services, and it's all built around this concept they call the Financial Services Productivity Loop, or FSPL.
Like FSPL.
Right.
And it's more than just cross-selling, It's actually about how they acquire customers. Imagine someone starts with, say, a student loan.
Yeah.
Then they add checking, then investing.
Okay.
Each time they add a product, SoFi's cost to acquire them for the next product goes down.
Ah, okay. So it's like a self-feeding loop.
Exactly. It turns their member base into this kind of growth engine. It's a pretty powerful economic moat, especially compared to traditional banks that often have, siloed products.
That is a brilliant strategy. So how is SoFi actually structured to leverage this loop? What are the key revenue engines?
Okay, so they have 3 main segments. First is lending. That's their foundation. Personal loans, student loan refi, home loans. And it's booming. Q2 2025 saw record originations. Personal loans up 66%, home loans up 92% year over year. It's huge growth. Revenue there comes from interest and fees.
Wow. Okay, what's the second?
Second is the technology platform. This is their B2B side, built mainly from acquiring Galileo and Technisys. They provide the tech infrastructure for other companies, fintechs, banks. As of Q2 2025, they enabled something like 160 million accounts. And the revenue model there is more like SaaS fees, interchange. It's capital light, high margin.
Got it. And the third?
The third is financial services. And this one's growing the fastest. Q2 2025 revenue more than doubled, and the contribution profit jumped 241%.
241%.
Yeah. This includes their FDIC-insured checking and savings, which is key. SoFi Invest, credit cards, insurance. It really is the full suite now.
So the value proposition is basically help people get their money right, all in one platform, good rates, community feel, and they're targeting hen rise, right? High earners, not rich yet, people with good future prospects.
Precisely. And they're achieving scale. Over 11.7 million members now, up 34% year over year, and 17.1 million total products, also up 34%. Plus, they're building the brand Think SoFi Stadium. They've got about 8.5% unaided brand awareness, which isn't trivial.
Okay, so how does this fit into the bigger picture? The whole fintech landscape is evolving so fast.
It really is. You've got major trends like real-time payments expected to grow almost 300% by 2030. And then there's AI, agentic AI. AI investment in fintech is projected to explode, maybe $12 billion last year to over $60 billion by 2032.
So how's SoFi playing in that space?
Well, they're integrating Galileo's conversational AI into their app. Think smarter lending, better fraud detection, hyper-personalization. It's a smart move.
Makes sense. But the competition must be fierce. Banks, other fintechs like Upstart or Block, neobanks.
Oh, absolutely crowded. But this brings us back to one of SoFi's biggest differentiators.
Which is?
Their national bank charter. They got that in February 2022.
Right. That seemed like a big deal at the time.
It was a huge deal. It means FDIC and Federal Reserve oversight, sure. But critically, it lets them fund their loans with low-cost member deposits, not expensive wholesale funds like many competitors.
Ah, so cheaper money.
Much cheaper. In Q2 2025, their deposit costs were nearly 2 percentage points lower than warehouse facilities. That translates to roughly $550 million in annualized interest expense savings.
Wow. That's a serious competitive advantage, a durable moat, like you said.
Exactly. And it overcomes huge barriers to entry, high capital needs, complex compliance.
So the bank charter is key. What else gives them an edge?
Well, their brand strength, as we mentioned. SoFi Stadium helps build that critical intangible asset. Then there's the network effect from the FSPL. high switching costs. If you have multiple products with them, moving is a pain.
Yeah, I can see that.
And it's working. 35% of new products in Q2 were opened by existing members. That shows the loop is functioning. And finally, owning Galileo and Techniques, those unique assets, it gives them control, faster innovation, lower costs, plus that B2B revenue stream.
Okay, let's move on. Chapter 2, management evaluation. Behind every company, there's leadership. Who's steering the ship at SoFi?
The CEO is Anthony Nudo. He's got a pretty distinguished background. It's Goldman Sachs, the NFL, Twitter.
Right, I remember him from Twitter.
Yeah. He's been pivotal since joining in 2018. Led those key acquisitions, Galileo, Technisys, Wyndham Capital Mortgage for the home loan piece, and, crucially, getting that bank charter. That showed real long-term vision.
And how are they on transparency?
They seem quite visible. Communicative management, detailed SEC filings. You can find a lot of information.
And what about insider confidence? Noto himself seems bullish.
He does. He's been a consistent buyer of SoFi stock since 2021. His latest reported purchase was over 30,000 shares back in June 2024. That sends a powerful message.
Okay, but you mentioned something earlier, a more complex picture.
Right. While Noto dies, the overall insider activity tells a slightly different story. Over the last 12 months, there were net sales of over 34.9 million shares by insiders.
Oh.
Yeah. Other executives like Kelly Keough or Jeremy Rischel seem to be consistent sellers, often through those pre-planned automatic sell programs.
So the CEO is buying, others are selling. What do you make of that?
It definitely raises questions. Some selling is normal, for liquidity, taxes, but a persistent pattern from other top execs. It does create a divergence. It's something investors need to be aware of. What signal does that send about their view on the valuation, perhaps?
Interesting point. Okay, so putting aside who's buying the stock, how is the company allocating its capital? Where are they putting their money?
Their strategy is very growth-focused. It's all about reinvesting capital back into the business. Those acquisitions we talked about, Galileo, Technisys, Golden Pacific Bancorp for the charter, that's where the money's gone, building up the tech and the platform.
So no buybacks or dividends then?
Nope. Consistent with the company still in a high-growth phase. They're plowing everything back in.
And is it working? Are they getting a good return on that investment?
Well, the return on invested capital, ROIC, has been pretty volatile because of all that investment. It was negative for a while, but here's a key development. It turned positive in Q2 2025, hitting 3.20%.
Okay, positive ROIC. That's significant.
Very significant. It suggests that management's big strategic bets, especially on building that integrated ecosystem, are starting to pay off in terms of efficiency. It's starting to translate that growth into actual, tangible returns on the capital they've deployed. That's crucial for long-term value.
All right, let's get to the numbers. Chapter 3, financial analysis. Does the strategy translate into tangible results? Market cap first. As of August 27, 2025, around $31.3 billion.
Yep. And the revenue growth has been, frankly, remarkable. Annual revenue went from about $750 million in 2020 to nearly $3.8 billion in 2024. And the last 12 months ending Q2 2025, over $4.1 billion. That's up more than 22% year over year. This top-line growth is, a central pillar of the bull case.
Okay, revenue is impressive, but what about profit? That's been the question mark for many fintechs.
And that's the other major milestone. SoFi hit GAAP profitability, generally accepted accounting principles, back in Q4 2024, and they've kept it up 7 consecutive quarters through Q2 2025.
7 quarters, that's consistency.
It is, and it's directly tied to that bank charter. Lower funding costs mean wider net interest margins. Their operating margins are positive now, too. And the net profit margin for Q2 2025 was quite healthy at 13.47%.
So consistent profitability, that definitely strengthens the case for durability. How's the overall financial health, the balance sheet?
It looks pretty solid. That debt-to-equity ratio is low, only 15% as of the latest quarter. That's strong relative to many peers in the financial space.
Okay, but I noticed something in the report, negative free cash flow, about minus $2.8 billion. That sounds bad.
Ah, yes, free cash flow. For a company like SoFi, especially in its growth stage and being a lender, negative FCF needs careful interpretation.
How so?
Think about it. When they issue more loans, that cash goes out the door now. It's tied up in growing the loan book. That shows up as negative FCF. It doesn't necessarily mean the business is failing. It's often a consequence of successfully growing their lending operations. You invest cash up front to generate interest income later.
Okay, so it's an investment in future earnings, basically.
Exactly. You still need to watch it, of course, but it's different than for, say, a mature industrial company. And remember those Q2 numbers. GAAP revenue over $850 million, net income near $100 million, diluted EPS 0.08 cents, all while keeping that debt to equity low at 15%.
All right. Let's tackle the elephant in the room, valuation. Is SoFi stock a good value at $26.15?
Well, from a relative valuation perspective,
Yeah.
it looks expensive. Quite expensive, actually.
How expensive?
The forward price to earnings, or PE ratio, estimates range widely, but let's say roughly 48x to over 100x. Compare that to the industry average, which is around 20x.
Oof, that's a big premium.
It is. The market is clearly pricing in a lot of future growth potential. If you look at peers like Synchrony Financial, their PE is maybe 9x, Ally Financial around 15x. SoFi's PE of, say, 105x really stands out. Price to sales, price to book ratios are also significantly higher.
What about intrinsic value, like a discounted cash flow analysis?
DCF models for SoFi show a huge range in fair value estimates. I've seen them from as low as $7 up to $30 per share.
Wow, that's a massive range. Why so wide?
It really highlights how sensitive these models are to assumptions, especially about future growth rates and the discount rate. You typically assume very high growth for SoFi in the near term, then slowing down, but the discount rate, or WACC, would likely be higher too, because SoFi stock is quite volatile. Its beta is 1.71. Higher beta generally means higher perceived risk, which leads to a higher discount rate, pushing the calculated intrinsic value down.
Okay, let's shift gears now into part 2. The horizon market, ownership, risk, and conclusion. Starting with Chapter 4, market sentiment. How's the overall market feeling about SoFi?
Wall Street analysts. It's mixed, but leaning optimistic overall. The average 12-month price target is around $20.65.
Which is below the $26.15 price we're using from August 27th.
Right. And that average hides a really wide range from $6 all the way up to $30.
Yeah.
The consensus rating tends to be hold or buy, reflecting that division. Optimism about the business, maybe some caution on the current price.
What about recent news flow?
Mostly positive lately. That strong Q2 earnings report, 43% revenue jump, profit up fivefold, got a lot of attention. Plus new partnerships, like with Lightspark for international transfers. So the media tone is generally upbeat, though often with caveats about the stock's volatility.
And technical indicators, what do they suggest?
Well, short interest is moderate, maybe 9.5% to 12% of the float, so some bearish sentiment, but not extreme.
Okay.
But technically, the stock price at $26.50 was significantly above both its 50-day moving average, around $20.65, and its 200-day, which was down near $14.32. And significantly, the 50-day was above the 200-day. That's a classic golden cross pattern.
Ah, the golden cross bullish signal for technicians.
Typically signal a strong uptrend, yeah.
All right, next up, Chapter 5, ownership structure. Who actually holds SoFi stock?
It's an interesting mix. Institutions own about 46.5%, maybe 47%. Big names like Vanguard, BlackRock, D.E. Shaw are top holders. And interestingly, several institutions, like Citadel and Toroso, were reported to be increasing their positions recently. That suggests some confidence from, sophisticated investors.
But retail investors own majority.
Yeah, around 58%. That's a high level of retail ownership.
And that might contribute to the volatility we keep mentioning?
It certainly could. Large retail participation can sometimes amplify price swings, both up and down.
And what about insiders, revisiting that? Noito owns a lot.
He does, over 10.1 million shares, and he keeps buying.
Yeah.
But as we discussed, it's nuanced because other executives have shown that pattern of selling. So it's not a unified signal from the inside.
Okay, let's move to a really critical section. Chapter 6, risk assessment. We'll use a SWOT analysis. Strengths, weaknesses, opportunities, threats. Let's start with the strengths.
Okay, strengths. First, that comprehensive super app platform, the whole integrated ecosystem. Second, their successful diversification into those capital-light, fee-based revenues. Remember that 72% growth in Q2. That's huge for reducing reliance on lending spreads.
Right.
Third, obviously, the strategic national bank charter, giving them that durable cost advantage. And fourth, owning their own tech stack via Galileo and Technisys, which allows for faster innovation and that B2B revenue stream.
Those seem like solid competitive advantages. What about the weaknesses? What are the internal challenges?
Well, number one has to be the high valuation. It just sets such a high bar for performance, leaves very little room for error.
Price for perfection, almost.
Pretty much. Second, while they're profitable now, there's still short-term pressure on margins because they're reinvesting heavily in the brand and innovation. It's a strategic choice, but a weakness in the short term, perhaps. And third, despite diversification, the lending business is still significant, so they remain vulnerable to shifts in credit quality or loan demand if the economy sours.
Okay, makes sense. What about opportunities looking forward?
Big opportunity in expanding that B2B technology platform. Taking Galileo and Technisys beyond just fintechs, think traditional banks, maybe even consumer brands wanting embedded finance.
Interesting.
And of course, further AI integration. Using AI for better efficiency, better underwriting, a more personalized customer experience, that aligns perfectly with where the industry is heading.
All right, now for the threats. What external factors could derail things? Competition is one, obvious.
There's competition, yes, from big banks and nimble fintechs. Regulatory scrutiny is always a threat too, potential new rules impacting the industry.
But the report highlighted something else specific, macroeconomic factors.
Yes, and this is really interesting and timely. The recently enacted U.S. tariffs of 2025 are seen as a major potential headwind.
How so?
Projections suggest they could shave up to 0.9 percentage points off U.S. GDP growth and maybe raise consumer prices by up to 2.3% short term.
Okay, so slower growth, higher inflation.
Exactly. That combination could really strain household budgets. And for a lender like SoFi, that means potentially higher loan defaults.
Right, more risk.
And if those tariffs combine with a weakening U.S. dollar, it could amplify inflation even more. This puts the Federal Reserve in a really tough spot. Do they fight inflation with higher interest rates, which would hurt SoFi's loan demand? Or do they support the economy with lower rates, potentially letting inflation run hotter, which also creates risks?
A difficult balancing act.
Very. It just creates a much more challenging and uncertain operating environment, especially for a business heavily involved in lending.
Okay, let's bring it all home. Chapter 7, Conclusion. Let's synthesize all this for you, our listener.
All right. The bull case is strong. SoFi has built this unique, integrated financial ecosystem, the FSPL. They have a growing brand, that crucial low-cost funding moat from the bank charter, and their own tech platform. They've shown rapid growth, good revenue diversification, and importantly, those 7 straight quarters of GAAP profitability. Add in a long runway for growth, strong cross-selling potential, and the CEO's consistent buying. It's a compelling story.
But there's a bear case, too.
Definitely. The bear case centers on that high valuation, little room for error, very sensitive to macro setbacks. The lending segment, while diversifying, is still exposed to economic downturns potentially made worse now by higher rates and those tariff impacts on inflation and consumer budgets.
And the conflicting insider selling.
Right, that adds a layer of caution. Plus, the negative free cash flow means you really have to believe in management's long-term reinvestment strategy paying off eventually.
So summing up the valuation picture.
SoFi appears priced for near-perfect execution. That wide range of analyst price targets, $6 to $28 or $30, really underscores the speculative nature of the stock at its current price point of $26.15.
Okay, so what's the final outlook for our listener, the long-term value investor?
Look, SoFi has made remarkable progress. They've built real, tangible, competitive advantages, no question. But the market has clearly recognized this and priced the stock with a significant premium for future potential.
So the key question is,
can SoFi actually grow into this lofty valuation? Are its moats, the bank charter, the tech, the FSPL, truly strong enough to fend off intense competition and navigate these potentially difficult macroeconomic headwinds like the 2025 tariffs?
and that current price, $26.15, being above the average analyst target of $20.65.
Yeah, it suggests the risk-reward profile right now might not be favorable for all investors. It really emphasizes the need for a long-term view and a clear understanding of the risks involved.
So what did this all mean? We've covered a lot in this deep dive into SoFi. But here's something to really mull over as you go about your week. Given SoFi's ambitious one-stop shop strategy and the, frankly, high expectations baked into its valuation, which specific strength do you think will be most critical for its long-term success? Is it the bank charter, the tech platform, or that financial services productivity loop itself? Especially thinking about those volatile macro headwinds we discussed. Which one has to deliver? That's it for today's deep dive. We hope this has given you a clearer picture and some valuable insights. And hey, if you want priority deep dives on specific tickers, make sure to like and subscribe to the Stock Analytics AI YouTube channel. For just €4.99 a month, members get exclusive priority access. We're actually covering all of the S&P 500 stocks over the next few months, so members get first dibs. Or if you just want a one-off deep dive on a company that matters to you, drop us a super thanks.
And just before we wrap up, the standard but crucial disclaimer. This analysis was generated by an AI system. It's for educational purposes only and should absolutely not be considered financial advice. Please please do your own research or consult with a qualified financial advisor before making any investment decisions.
Great point. Thanks for joining us on the deep dive. We'll be back soon with another exploration into the data. Until then, keep learning.